All right, so they'll be pushing live to the virtual platform now.
They see a video of me.
Yes, you are sharing your camera, so they will see.
Okay. I just have, like I said, I have no way to blur it. That's okay. Okay. And now the audio is fine. It's just me. Like,
Yeah,
like,
audio sounds good. I'd like to welcome all those just logging on to Money Show's virtual expo. Thank you so much for being here. We do have about 3.5 minutes before the start of the session, so sit back. We'll be back with you momentarily. Thanks again for being here. All right, Henry, we're about a minute out, and I'll lead us off with a quick intro, and we'll be ready to go.
Perfect.
And a great day to everyone joining us for Money Show's Virtual Expo, your 2026 portfolio review. Thank you for being here. We are pleased to welcome Henry Yoshida, the CEO and co-founder of Rocket Dollar. He was previously the founder of venture capital-backed robo-advisor retirement plan platform Honus Dollar. Acquired by Goldman Sachs in 2016, the founder of My Group LLC, acquired by CapTrust, and spent 10 years at Merrill Lynch. Henry's also a certified financial planner and has brought multiple innovative products and methodologies to the market. Henry, thank you so much for taking the time out. It's all yours.
Thank, Thank you very much. I appreciate it. I'm happy to be able to speak to all of you. And as Mark mentioned, I've been in financial services for a very long time, but I've very specifically been in an area of financial services related to retirement and tax advantaged accounts. So hard to believe that I've actually been in this space now for 25 years across corporate and three companies, the current one being Rockefeller. And today I wanted to talk to you about one of the things I've seen for this entire century. So we are now 25% of the way through this century. And I've titled my presentation, The Downfall of Traditional Investment. Ironically enough, when I started at Merrill Lynch in the year 2000, alternative investments then were mutual funds that invested in public companies, but were traded on the stock exchanges of countries outside the United States. Come a long, long way from that point. And I'm not going to go into what alternative investments are specifically. I think everyone understands that. But I wanted to talk a little bit about why I believe just over the course of the 25, 26 years that I've been working with retirement accounts and been in the financial markets across creating companies in the space, as well as formally consulting in my investment advisory firm on about $2.6 billion, why that 60/40 model portfolio no longer works. It had held true for a long, long time. And I just think people need to play this game a little bit different. So, for decades, this playbook was very, very simple. At that time, you were able to diversify those. So the 60 represented public equities, while the 40 represented fixed income, or more commonly known as bond investment. And what had ended up happening was mathematically, since the turn of this century, the returns and the risk uh, from correlation between stocks and bonds have actually gotten very, very similar. So this has forced investors who want to have a properly diversified portfolio. So, quite frankly, to put in more layman's terms, a portfolio where you have some segments or some investments that might zig, while something else might zag. So, you used to be able to do that between stocks and bonds, but mathematically now they're more and more correlated. So, now, of course, we're in a position where stocks are somewhat crowded and possibly overvalued. And again, related to bonds. And then passive indexing has really turned more into a herd investing type of mentality where people will simply go into these index funds. And technically, for all intents and purposes, now the voting rights of many of the largest major corporations are actually concentrated in the hands of some of these index providers themselves. So now, how do you achieve diversification inside of your portfolios? That's kind of the reason. And as someone who's operated in the investment market space, particularly in the traditional retirement investing space for many, many decades, I created a company in 2018 that kind of allowed me to capitalize on what I think is sort of the new opportunities for folks to have a properly diversified portfolio and positioning yourselves as retail individual investors who maybe play the game the way that institutional and large investors have done now for decades. So there's three systemic forces that are reshaping these markets. Right now, Wall Street will serve managers, not investors. The retail access is late stage and overpriced. And I'll get into more details for all three of these points here. And the public markets represent a shrinking opportunity. So in this case, Wall Street serves managers, not investors. So we're in a position now in the United States where roughly registered investments, there are about 3.5 to 4 times as many registered mutual funds as there are actual publicly traded equities in the United States. So when I started in my career, there were close to 10, 11,000 publicly traded companies. And that was right in May of 2000 when I graduated from my undergrad. And now we're sitting in a position where there are roughly 3,700 publicly traded companies. So that number has actually shrunk quite a bit. But in that same time frame, the number of registered funds, ETFs, mutual funds, and so forth have actually exploded. And now those are in excess of 10,000 different funds made up of the same 3,700 or so publicly traded equity, concentrated in the equity. Now, retail access is late stage and overpriced. So we came from a position of being able to invest in smaller microcap type companies when they went public. Case in point here that when companies, some of the eponymous ones that we know today, like Amazon, Microsoft, and Apple, had actually entered the public markets at a point where their market capitalizations were less than $100 million per year in revenue, not market cap, but in revenue. And we're in a position now where companies are able to access private capital, stay private for much, much longer. So examples I like to use are OpenAI, the parent company of ChatGPT, and SpaceX, one of Elon Musk's other companies outside of Tesla, which is publicly traded. Both those companies, if they were to debut right now in the public markets, would actually already be in the top 10, pushing close to $1 trillion valuations. And as a matter of fact, I'll talk about this in a little bit, but we have customers using our product right now that have gone into SpaceX. So I can see that they're marketing these stocks that were purchased in secondary markets at roughly a $750 billion valuation for SpaceX. And so, because of that, public markets represent a shrinking opportunity. So, we no longer have the ability to invest early in these companies. They stay private for much, much longer. And that is forcing us as retail investors, where we don't get a chance to participate in these investments until they become very, very large. And at that point, they become public. So, what's happened now with the public markets today are that you now go public as a way to create liquidity for institutional and large private investors. Whereas in the past, you went public to access capital from a large pool of retail individual investors to then grow your organization or your company. It's completely flipped in the last 25 to 30 years. So, because of that, the return generation has gone private because you get to participate if and when OpenAI or SpaceX goes public. They will already be top 10, top 15 for sure, possibly even top 10. Maybe one of those will be even top 5 by market cap on the S&P 500 when it's public. So, in other words, us as individual retail investors never had a chance to participate in the growth from the early stages of those organizations, large stage. So, the return generation has accrued to the investors on the private side of these particular. Now, they're no longer on the fringe and they're actually the frontier. So, these markets have actually grown so much that by market capitalization, they represent a larger part of the available investment pool. Unfortunately, a little bit difficult to access, and rules and regulations are starting to begin to change. I've been following this very, very closely since I started Rocket Dollar in 2018. It's the reason why I shifted from being a traditional 401k consultant to actually now creating a platform to help regular retail individual investors tap into money that they have to go into private and alternative investments. And as I've been doing this in parallel, I've seen many, many more platforms, opportunities, and just structural, regulatory, and legislative changes that have made it easier for individual investors to access private, non-registered investments. Case in point, I can see that our customers are able to purchase through certain platforms, the ability to go into organizations like SpaceX, albeit at somewhat later stages, but we have some people who invested earlier as well. Now, what I believe is that the new frontier will be that private opportunities will deliver what public markets have struggled to provide over the last 25 years. So I think that they should still go hand in hand with the public investment opportunities in a private investment portfolio, but they need to work together. So no longer is it the case where a 60-40 portfolio will be made up of public bond and then public equity type investment. It might now be made up of private investment, whatever those may be, private credit, real estate, private equity, investments in private companies, primarily in the technology space, against like public equity type portfolios to create that new optimized balanced portfolio. So right now, the private opportunities, depending on which one you go into. So if you go into private credit or real estate, you're giving yourself tremendous yield opportunities. And by going into those types of investments, you can get the interest that you might need depending on what goals are for your investments. If you go into some of these early stage private equity backed technology companies, you have the chance to participate in the growth of these organizations because, again, they're not going public like Amazon when they were doing under $40 million in annual revenue. They're now staying private until they get to the point where they're in value of in excess of $100 billion in market capitalization. So to participate in the growth, let's say from a $1 billion company to a 50 and $100 billion company, you need to have the ability to go invest in the organization while they're privately held and not publicly traded. In another sense, you gain control in the private investment opportunities. So I'll use the case in point of real estate. You were to purchase direct real estate as a part of your overall diversified portfolio, you actually effectively control that real estate holding or that portfolio. I'll use the example of a single family home. For example, yep, I would argue that you would have, as the investor who purchases this investment, much more control over that than you might over the machinations, strategic and corporate direction, major corporation ranked in the S&P 500. And then from a tax optimization standpoint, it depends. If you go into real estate, you have the opportunity to take a lot of deductions of your expenses for holding that investment as a part of your overall portfolio in your investment life. Secondarily, if you were to invest in one of these early stage technology companies and you were to hold those investments in account platform I provide at Rocket Dollar, you'd be able to optimize your taxes because you'd be able to defer what might be the potential for very high growth. Even more so if you were to structure that account and purchase these investment early stage companies using a Roth IRA. So you have some flexibility on the tax optimization side. So these are the things that I see in the private investment markets as a way to maybe become this new ballast and the uncorrelated zag to the public equities markets, inclusive of bonds and stocks, when they zig, for example. So that leads me to the point where I wanted to talk about how this comes together for me and how I saw it. But one of the things that I noticed, and this is the point I want to overlay, is that when I started my newest company in 2018, that was at a point where roughly $25 trillion was sitting in overall retirement accounts. Because I give this presentation and people always ask me that, hey, as a retail individual investor, I don't have the money. Most of my money is tied up in a 401k or IRA type product. And those products are with providers that only allow me to go into these public stock market and public bond market type investments. They're offered through major brokerage houses, do-it-yourselfer organizations like Fidelity, Vanguard, and Schwab, or through my financial advisor at Edward Jones, Merrill Lynch, Morgan Stanley, for example. And I don't have the ability to invest in some of the things that you just talked about to diversify my portfolio for the 21st century. So when I saw that the markets in these types of accounts, just IRA, 401k, pension in the United States in 2018, were holding close to $25 trillion, it made me realize that someone needs to more easily create the ability for folks to tap into those types of monies because they have characteristics that actually align better with holding private investment opportunities in your portfolio. So those two characteristics would be that you needed a longer time horizon because they're somewhat more liquid, they're more opaque, they're longer time holds, and then you need good tax treatment inside of those accounts. Of course, as Americans, we were holding at that time 25 trillion. Cerulli's data at the end of 2025, the most recently recorded data, shows that now these retirement accounts hold in excess of 45 to 46 trillion dollars overall, of which the largest subsegment is now IRAs, pushing close to 20 trillion dollars. So if I can help folks tap into those accounts, then they can go identify these private investment opportunities and whatever type of private investment opportunity suit the individual, whether that is real estate on one side of the spectrum, a tangible investment holding. Let's say you want to be a little bit more passive and you just want to invest in a fund that might then invest in private real estate or private credit or into private companies themselves. You can become a limited partner in a private investment fund. And maybe on the other side of the spectrum, we have many, many customers who are now exploring the opportunity to hold digital assets, cryptocurrency, using these tax advantage long-term IRA type of accounts. And in these accounts, one of the things I wanted to dispel was that although the 60/40 model portfolio is no longer just a mix of stocks and bonds, but maybe now should include a mix of private investments against public investments as a way to properly diversify for the next 25 years of portfolio. It's been little known that American investors have always had the opportunity to invest in private and alternative investments using their tax advantaged IRA and 401k accounts. As a matter of fact, the IRAs and 401ks themselves are now reaching 51, 52 years of age as we sit here and talk in the early part of 2026. They were created by the ERISA Act of 1974. That stands for the Employees Retirement Income Security Act of 1974. And that is the rule long ago that established probably the type of account that many of you hold a lot of your investment inside right now. So you typically, people would accumulate these balances by contributing portions of their salary into a 401k type module offered by their employer. And as they move from job to job, they're able to transition that 401k money, keep the same tax treatment, and then roll those into an individual retirement account of their own name. And of course, companies like Fidelity, Vanguard, and Schwab are now servicing respectively 13, 10, and 7 million account holders. So IRAs are great because they're tied to the individual, not the company. Many of you, if there are 1,000 people listening to me today, there might actually exist 1,300 IRAs amongst you because people tend to have more than one account. Um, you can have as many as you need. And even if you have, you might still be in a position where you didn't consolidate and you have a lot of old 401ks. Now, the only time you can put new money into an IRA account is if you have US based income. And for 2025, that number was 7,000, established to stay the same here for 2026 as well. Now, there are different types of these types of accounts that you might have, then go access these private investments. But the real key factor here is that you do not have to pay tax on current income. So the reason why I want to stress that I'm advocating that individuals need to allocate or need to start to identify opportunities to access private investments as a part of their overall diversified portfolio. The way to potentially do that and mirror the characteristics that are best aligned for holding of private investments are inside of tax advantage long-term accounts like IRA. So that's why I want to get into how and why you might be looking at using types of accounts. So you have common types of IRA accounts, which include um, traditional IRAs or Roth IRAs. And I think people know the differences between those, but I like to sum it up by saying the traditional IRA is money that you have in your retirement account that you've never paid tax on. So when you take money out, you will pay taxes on it. The Roth IRA, named after a late senator from the 90s, is that you pay tax on the money you put into the IRA, and thus whatever you invest in and whatever it grows to will not be subject to taxes. So if you had contributed overall over the course of several years $100,000, but the investments you had inside of the account had grown to $600,000 over the course of the next 20, 25 years, you wouldn't have to pay tax on that $550,000 gain on top of your 100,000 and so forth. The less common types, I just listed them here, but you could have accounts for minor children, depending on where you might be. If you're part of the sandwich generation like me, you might end up getting a notification you have an inherited IRA from a relative generation above you may have passed away. But regardless of the type of IRA you have, what they all have in common are no capital gains taxes, the ability for tax deferral throughout the entirety of when you hold that account, and in some cases, to a certain extent, even after you pass away. And by definition, they're not a brokerage account. So brokerage accounts are just a simple definition of taxable account. And what I'm advocating, or what I'm trying to talk to you about, are what are called self-directed or alternatives capable IRAs. So these are IRA accounts that are structured that allow you to hold private and alternative investments, of which I talked about need to be the foundational part of a fully diversified portfolio in modern times today. Again, mirroring the characteristics and also likely matching up to where you have accumulated funds to go into long-term investments that are somewhat illiquid and might benefit from having better tax treatment. So these are the types of IRA providers. They're no different than the IRA that you might have now through some of the discount brokerage houses that I just named over the last couple of minutes. But really, what does that mean for you? Individuals still need to identify. So this presentation isn't about where you would find these types of private and alternative investment, more to help you understand that there's a component of what type of investment that you need to hold for your portfolio. And then there's a secondary consideration that might be where and what type of account you might hold that portfolio that best suits that particular investment. So to put it all together here, I think in my case, I'm advocating that you need to have and identify and start to understand and look for opportunities in the private investment markets because that's where the growth potential is going to be. It's where a lot of the money is shifted to. And again, the stock market itself has become a little more and more concentrated in the course of the century. So for you to look and properly diversify across industries, across investments, build your own investment portfolio, you might need to look into the private markets. Now, pairing that with the account type where you are likely to have money that you cannot use for a sustained period of time, typically age 59 and a half and beyond, as well as having built-in tax advantages, that would be your IRA account. So I'm asking you or advocating that you kind of combine those two. So in an IRA, unbeknownst to folks, you can hold private investments inside of these accounts. You don't have to do it with taxable cash out of pocket money. You can hold almost any active or passive investment and still get the treatment where you avoid the capital gains tax and have the deferral up until age 59 and a half and beyond. Obviously, you can access alternatives that potentially move differently from the stock market. And I think that, definitely the case now since I've been in the investment markets and I've seen this happen from 2000, 2026 and on. So as long as those investments are legally named in your IRA, private investment, then you can retain those tax benefits. And as far as the listing, I listed some of the private investments just when I was talking about that generally, but that same list are things that you can own inside of an IRA account versus outright in the private market. So real estate, private equity, venture capital and startups, crypto, farmland, energy limited partnerships, private lending, private credit, precious metals, and basically anything else that's allowed by the IRS. And the way the IRS defined this, even back in 1974, was not by creating a list of investments that you can invest in, but they actually only codified and identified particular investments that you can't. Those particular investments were only listed as life insurance and collectible type investments. So collectibles might be things like your paintings, artwork, or a classic car that has more value above and beyond just being a car. Those types of things are not allowed to be held inside of an IRA. But outside of that, a lot of the private investments, the ones that you would use to ballast your portfolio in the new 60/40 model for 2026 and beyond, can be held inside of these accounts. And now you're combining where your funds are with the right tax treatment, long term time horizon, with investments that are better suited for that, which are not the public. So, uh, in a way, now technology has set it up to where companies like myself or others have the opportunity for you to create these types of accounts in the exact same way that you would create your account at traditional providers or the for your typical IRA type investment. So you go online, you give your personally identifiable information, you get the account established. Once that account is established and you have the account number, then you're in a position to be able to transfer old 401k in the form of a rollover or transfer funds from a traditional IRA at a discount brokerage house in the form of cash so you can make this private and alternative investment. And then after that, the investment is now working for you, very similar to any of the stock investments you might own additional account right now. For me, though, I think that the world today is that you may have invested in an early stage company and participated in growth while holding it in your public account. But more and more, a lot of what I think will be the new banner, the next Magnificent Seven, are not currently available for folks like you and I to invest in from a public standpoint. And we might need to identify platforms and look for syndications that allow us to participate in these businesses at earlier stages while they're privately held. And then the liquidity comes when these companies go public, at which point that is the end game for them. But again, as I mentioned, 25 and 30 and 35 years ago, 35 years ago and 30, roughly when companies like Amazon started, the initial game was for them to go public so that they would use that vehicle to access capital. Now it's completely flipped where you are now able to access the capital and liquidity comes as the public. So you need to be ahead of that as investors going into the next 25 years of managing the portfolio. And then if you were to go online, you open this account with us, same step process with any investment type provider, but essentially you would open an account, transfer funds in, then you'd have the ability to invest. And then at that point, you probably would continue to add investments, look at this as a part of your overall portfolio, and then manage that. But I think that in this case, depending on your risk tolerance, your access, your ability, and your accreditation status, you might be looking at needing to do a double-digit percent to begin with, so 10% or more going into private markets. And I think as time goes on, there'll be more and more opportunities. You'll be hearing more and more about how private investments are more and more accessible to the retail investor. And if you do that, you might want to consider making sure that you have the right account type to hold those particular investments. And Mark, I just wanted to, I know we have about 5 minutes left. I wasn't sure if people had the ability just to maybe ask one or two questions, but
Yeah.
I'm going to go back to this one, but just kind of,
Yeah, absolutely. We had a viewer here. They're wondering if you don't mind elaborating a bit on what types of alternatives are on your platform and if you vet them.
so on our platform, we're kind of similar to maybe an individual who decides to be a do-it-yourselfer at a place like Schwab or Fidelity, for example. So we have chosen um, the entirety of my career, I've been in a position where I guided and I managed and I vetted um, and selected investments on behalf of clients or institutions, customers. But in this particular platform, I chose instead to stay at that platform level where people open the account and they vet those investments. So across our customer base, we have roughly $12 billion of overall private investments. They're represented by about 7,000 different private investments. We do not vet those investments. The customers themselves find them. We find that that actually leads them into better private investments because it's something that they know. I'll elaborate here, and this may not be the exact question that your audience member had asked, but it's related to real estate. If someone is selecting a real estate investment portfolio, whether that's becoming a limited partner in a small private equity real estate fund or buying a property outright, that individual, depending on where they are and their knowledge of that market, is going to be better than our ability to vet that for them. We've just had more success by being the platform that helps people unlock their money so they can go into the investments out on their own. Now, that being said, we have a partners page to kind of identify some of the broader platforms, a couple of which we have highlighted on our website are the ones where you could purchase secondary shares in companies like SpaceX, Anthropic, Stripe, OpenAI, and so.
All right, excellent. Thank you so much. Another question, among the alternative asset classes you see on the platform, which are gaining the most traction and why now?
So I think right now, people are fearful. So our customer base, so probably aligns really well with your audience. They tend to be, people who have somewhat accumulated funds, maybe even defined as massive funds. So depending on your age and stage in life, I define that as 250,000 of overall investable assets and above, and 250 lower end of that range is for someone who might be in 30s, for example. Maybe that number 400 to 600,000 investable assets outside of equity, property, and home for primary residence purposes as they get into the 40s, 50s, and obviously 600,000 and well beyond from an investable asset standpoint. So because of that, with that context of those types of investors at that level, where we've seen the fastest growth is actually private credit funds and also real estate. So that leads me to believe that someone who has a pretty decent base of investable assets right now is really starving for yield, consistent and high yield, in against the backdrop of potentially lowering interest rates. Basically, difficult to generate income yield outside of that. So they've been tapping into the private credit markets and real estate, which is generating high return.
All right, thank you. If you could flag one regulatory development that would most impact self-IRA directed IRAs, what would it be and how should people prepare?
Sure. So this is a little bit of a step removed and a step above, but back in August of 2025, President Trump, sitting President Trump, signed an executive order to make it easier for private equity type funds to be available inside of public 401k plans. So I know that this is at the employer level before it goes to the individual IRA level, but that to me is a signaling that the administration is starting to recognize, or the regulatory and the financial bodies are starting to recognize that they need to allow access because if you have a 401k portfolio that is pretty similar, whether you are with Microsoft, Deloitte, American Airlines, any large corporation, to the 401k plan for a 10-person veterinary medicine practice in your local city, the menu actually looks very, very similar in terms of the types of funds offered. But to my point, it's all public investments. It might be becoming too restrictive, and to that end, even the administration now is passing executive orders, basically giving employers and giving a tacit, somewhat approval of partially opening the door, say that we need to allow some of these private type investments inside the 401k plans, and that'll have a trickle down effect to the IRAs. So I think that's number one. And then number two is that twice during that sort of COVID pandemic era, there were threats in the administration prior to the Trump administration that had threatened maybe some of the tax advantages for private equity type investments, in particular, some that would affect private holdings inside of an IRA. But neither one of them came to pass. They didn't go any further than just kind of being mentioned, making some headlines, and they haven't been talked about since then. So I think like sort of the just the disappearance of those, as well as a new executive order more recently in August really paved the way for understanding at a regulatory administration level that private investments are here to stay and they're growing and they need to be available to all individuals.
All right, excellent, Henry. And we just have a couple of seconds here.
Sure.
What's the best way for any of our viewers to contact you and your website?
Sure. And this website is really set up for education purposes, but it is where people can um, uh, go. But if they go to rocketdollar.com, we have a lot of information on the website in our, we call it a knowledge base area. So maybe more commonly known as an FAQ, frequently asked questions. But there's a tab there for that. If you're just looking for education type information, that could be everything about these types of accounts, IRAs, private investments, and so forth. So that's at rocketdollar.com. And then, although we fashion ourselves as a technology company, on the upper right hand side of our page, we have a phone number, 1-855-762-5383. And this is just set up for you to ask questions and learn a little bit more, help give you the comfort that you might need, help you understand if you're an eligible customer, if you have an eligible account type to move over. And for those that remember that phone numbers used to represent letters and we used to have to text that way back in the day, it's 1-855-ROCKET-D.
All right. Well, everyone, we're speaking with Henry Yoshida, CEO and founder, Rocket Dollar. Henry, thank you so much for being here. We greatly appreciate you.
Thank you very much. Appreciate it. Thank you very much. Have a great rest of the conference.
Thank you. And a big thank you to all of those in attendance. You're watching Money Show's Virtual Expo, your 2026 portfolio review. Stick around. We have more great content just like you saw here coming your way on this last day of the event. Thanks so much for being here.